Ladies and gentlemen, good day to all. I'm Cyrus, research analyst from iFAST. Looking for a promising investment opportunity in the ever-evolving world of finance? Well, look no further. We've got some exciting news for you regarding A-shares, a segment of Chinese equities that could offer you a fascinating ride to potential profits. Strap in and let's explore why A-shares might just be the ticket to better investing into China. First things first, let's talk about regulatory risks. In an era where regulations can make or break an investment, we think A-shares are less susceptible to regulatory risks compared to other Chinese investment options. And this means that you can sleep a little easier at night, knowing that your hard-earned money is likely in a more stable and secure environment. But that's not all. A-shares have another ace up their sleeve. They tend to be more aligned with the priorities of Chinese authorities. Now you might be wondering, what does this mean for you as an investor? Well, it means that when you invest in A-shares, you are riding the wave of initiatives and policies supported by the Chinese government. And to us, this alignment gives us a greater sense of confidence in A-shares. Now let's talk correlations. A-shares typically have a lower correlation with global equity markets compared to the broader Chinese market. But why is that a good thing? Well, this domestic-driven nature can act as a shield against global market volatility, making it a better option for portfolio diversification. It's like having a sturdy ship navigating the seas of uncertainty. So what's the bottom line? Well, we recommend a tilt towards A-shares within the Chinese equity space. By doing so, you may position yourself for a potentially fruitful journey. We anticipate a potential upside of 9% by the end of FY25, better than what we are forecasting for the broader Chinese market. So there you have it. A-shares with their resistance to regulatory risks, alignment with state priorities, and lower correlation with global markets offer a captivating investment opportunity. To get a full analysis, scan the QR code or click on the link in the description below. Next up, Dejun will share with us on how to prepare for a recession. Over to you, Dejun.
Hi everyone, I'm Dejun from the research team at iFAST. The US economy, once sailing smoothly through the late cycle expansion phase, now finds itself facing dark clouds on the horizon. With tighter monetary policy and higher inflation leading to lower consumption and business investment, economists and industry leaders have expressed concerns that a recession may be on the horizon. Minutes from the latest FOMC meeting in May offered a glimpse into the Fed officials' concerns, revealing that they expect the tightening of financial conditions following the collapse of several regional lenders to potentially result in a mild recession later this year. These revelations further fuel the fears circulating among experts and investors alike. Furthermore, the decline in leading indicators, which serves as a compass for economic performance, reinforces the notion of a slowing US economy. A staggering 93% of US CEOs also share these concerns, with the majority anticipating a recession within the next 12 to 18 months. These figures should act as red flags that should not be taken lightly. And given the precarious state of current affairs, it becomes crucial to evaluate investment strategies that can help to navigate this uncertain economic landscape. Going forward, we continue to favor fixed income over equities, particularly short duration and higher quality bonds. Short duration bonds in particular have experienced a sharp rise in yields relative to their long duration counterparts, allowing investors to receive greater returns without having to take on additional duration risks. And when it comes to equities, focusing on quality and value stocks and also commodity-linked equities appears to be a prudent strategy. Quality or value stocks, they are known for their resilience during economic downturns, whereas exposure to commodity-linked equities may be beneficial as inflation remains elevated. Additionally, we also recommend keeping an eye on opportunities in markets like Japan and ASEAN, as these regions may offer potential growth and diversification. To get a full analysis, scan the QR code or click on the link in the description below. Next up, Dwight will share with us about Shandong Steel. Over to you, Dwight.
Hello everyone, this is Dwight from Global Fixed Income team. Today I want to share a bond investment opportunity on Shandong Steel. This issuer is the seventh largest steel producer in China and is a SOE, and Shandong government owns about 90% of the share. This issuer delivered indecent results in 2022 due to the weak demand for steel and the increasing production cost. Besides that, the steel price decreased by more than 30% in 2022, resulting in significant decline in both revenue and net profit. But don't worry, with China reopening this year, the steel demand is bottoming out, and the operating performance of Shandong Steel will likely improve. From the perspective of credit profile, the gearing ratio is managed at a relatively low level after a serious deleveraging in recent years. Liquidity-wise, as a typical asset level industry, steel producers usually face funding shortfall, but benefiting from the SOE background, Shandong Steel has a rather strong capability of fundraising, and the unused credit facilities could cover the debt repayment in coming years. For investors, Shandong Steel 224 USD bond is a rather good choice. The bond has a yield to maturity of 7% and is one of few bonds issued by steel producers that can offer 7% return over a 1-year investment horizon. To get a full analysis, scan the QR code or click on the link in the description below. That wraps for the sharing of this week. Catch us again next week for more investment ideas and updates.